Okay, let's go right on to our second inventory costing method. We just talked about specific identification. Now we're going to talk about first in, first out, or the FIFO method. All right. The first in, first out method is telling us that the first items we purchase, the first to come into our store, those costs are going to be the first ones assigned to items as they go out the door. So think about this. As we buy more and more inventory, as Target buys more and more paper towels through the year, on January 1st, let's assume they have a calendar year, fiscal year. On January 1st, they're paying 50 cents a roll. Throughout the year, they're going to pay higher prices a little bit here and there. And by the end of the year, maybe they're paying 90 cents a roll. The price has changed. Since we have, during the year, purchased inventory, which was available for sale at different prices, we have to keep track of how much we bought at the different prices. What number of units did we buy at each price? All right. So if we look at the slide, it says cost of goods sold. Those are the items customers bought, took out of our inventory, and walked out the door with them. That cost of goods sold number, since we are basing it on the first prices that came in, the cost of goods sold is going to be based on those first prices. Those are our earliest prices. They are the oldest purchases. So if we're in a period where prices are going up, the cost of goods sold number is going to represent lower prices. Right? Those are the items bought by customers. What about our ending inventory? What's remaining in the store? Well, if people buy our items and we are eating up the lower or the earliest cost buckets first, then what's remaining are those later cost buckets, those cost buckets that are higher in price. And they probably more accurately represent the current replacement cost for those items, okay? Because they're closer to being current. All right. When we talk about cost of goods available for sale, don't confuse it with cost of goods sold. Available for sale means all the inventory that was available during a period. What was the total cost? Now, some of the available for sale will be transferred to cost of goods sold because customers will buy them, and the remainder of them will be kept in ending inventory. Okay, so you have a if I'm Target, and during the year, if I add up all my January, February, March, all the way to December, and I said I purchased 1,000 paper towels, and the sum of the cost of those paper towels was $950 to me, at the end of the year, I know that some of those paper towels were sold and represent cost of goods sold, and the remainder of them stay behind as ending inventory. We're going to look at a number example next. Oh, hang on a second. Here we go. So here's that table again. Get comfortable with this table. Recreate it on your paper. This is an example of first in, first out. We have our three columns, and I'm going to point this out a little clearer now. We have our three broad columns, rather, purchases. So those are the account for the inventory that we buy and that comes in. Cost of goods sold is our second broad column. That accounts for the items that customers buy and take away from our store. So they're no longer in inventory. All right. And then our third column is inventory on hand. Those are the items that have not been sold and they remain with the store as part of their inventory and they are still available for sale. So let's start this example. On August 1, they are telling us at the beginning of the period, when we open our doors, we have 2 units available for sale. We paid $350 for each of them. So again, if this is Target and our couches, I have 2 in the store. Target paid $350 for each of them. So right now they have $700 in inventory on August 1st. When they realize, wow, couches are becoming really popular, we need to get some more in inventory, they go and they buy 4 more. However, by August 5th, the price has already bumped up. They don't care. They buy 4 more, and this time they pay $360 each. So if I come over here, this column is where I am keeping track of all the inventory that is available for sale. So what do? Every time I have a new date, I draw a line and I keep my layers intact. I still have 2 units available. So I bring it down here, but I keep it separate because it's a different price bucket. I still have the 2 units at $350, but I have added to them 4 units at $360. I just bought those. So if I do the math, 4 at $360 plus the 2 at $350, my total inventory is valued at $2140. But you're about to see now in the next example why we need to keep these price layers separate. On August 15th, remember we're operating under the FIFO method. We sell 4 units. I told you under FIFO the first items in terms of cost are the first costs we assign to cost of goods sold. So if I sold 4, I'm going to go to these layers and I'm going to say, okay, this was my first cost layer in. I'm going to eat this one up first. It's going to go away. And I'm going to bring it here. I sold 2. My first item out was my first cost in. So I sold 2 at $350. Then I still have to account for 2 more because I sold 4. I'm going to go back to my inventory. Where's my little cursor? There it is. This layer is now gone. We used it up. I have to now go down to this layer and take 2 at $360 out of here and bring it over to cost of goods sold. So I have accounted for 4 sofas that I sold according to the first in, first out method. So if I do the math here, 2 at $350, 2 at $360, my cost of goods sold on this purchase is $1,420. So we've got that number. Let's go back to inventory. I completely remove this layer. So as we come down here, you can see it's no longer there. The $350 bucket is gone. What else did I do? I also took 2 units out of my $360 bucket. So when I come down here, I keep losing the cursor, sorry guys. When I come down here, the only thing I have remaining in inventory are 2 units at $360. Okay, so let's finish with this problem because I think it's the best way to really get a hang of this. So on the 26th, on August, I'm saying to myself, now I'm running low on sofas again. People are buying them. Let me buy 12. Now the price has risen to $380. So remember what I said. I go across. What do I have in inventory now? Well, these 2 units up here, I'm bringing them down again. I still have them. If it's a different price bucket, they go on a different line in the inventory on hand column. So I still have them. I just drag them down, and then I add to it the 12 units at $380 each. So now on the 26th, I have $5,280 in inventory. Let's practice one more sale. On the 31st, I sell 10 units altogether. I am using a first in, first out method. Okay, so 10. I have to go to my earliest cost bucket. That's this. I have to use up 2 units at $360. Take them out of inventory and assign them to cost of goods sold. Okay, the first one's in or the first one's out. That layer is gone. But I have 8 more units that I sold and I have to account for. Sorry, I keep losing the cursor. I have 12 units here. I'm going to take it out of here. I'm going to take my last 8 at $380 out of inventory and into cost of goods sold. So 8 at $380 is $3,040. If I add these both, the sale of my 10 units was a cost of goods sold to the company of $3,760. That's how much the company paid for those 10 sofas. We are not capturing in this process, in this table, we are not capturing how much revenue, what did the customer pay us? It's not here. This is only how we record the inventory. So one last thing to do here. I go back to inventory. I got rid of this entire top layer of $360. I removed 8 out of these 12. People bought them. The only thing remaining that is still available for sale is 4 units at $380. Okay, so my ending inventory is as calculated in your last date here, $1,520, and my cost of goods sold is the sum of each purchased item. Okay, for $5,180. I'm going to just quickly reference you to this. You can look at these entries. This is showing you on, this relates to the table we just went over on August 5th. This is how you record the purchases. You debit inventory, you credit account payable. On the 15th, we had a sale of 4 items. Remember what I told you about every time a merchandising operation creates a sale, you record them. You record 2 entries. One is to capture the revenue. Here's where we see the revenue number. So our customers owe us 4 units times $500 each. That's our sales price. So we capture revenue here with a credit. The second entry is to capture cost of goods sold. That's what we calculate in that table. If you go back, cost of goods sold for that first purchase right here, $14.20. Debit cost of goods sold because it's expense. Credit merchandise inventory. Here are your 2 entries. Take a minute, look at it. Revenue minus cost of goods sold will give us gross profit. So we've captured that here. All right. These entries go through and they line up with the activity and inventory on the previous slide. Make sure you understand them and go through them. Okay. LIFO coming up next.